I wake up in the morning, I go all in. It's just my nature, that's just who I am. And Marco is the same. We just make it happen. We just go. That's why we became coaches, because we got the energy behind us. We got the ability to stick to it and go in and just persist, stay focused. So we have students in the mastermind who said they're going to do the underwriting course, and they need a bit of a reminder every week. Hey, how did you get on? Did you do the next chapter? So it's very, very important. Accountability is the glue that ties commitment to results. That's the last thing. It's really, really, really important.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwayne Clark.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwayne Clark, and today we have Hadar Orkibi. He's a seasoned multifamily and commercial real estate investor with holdings in New Zealand and the United States. He founded the company MFI Holding, which focuses on Class B and C assets. Hadar, thank you so much for joining us on the show. And how you doing, my friend? Very
good. Thank you for having me, Dwayne. I'm excited to be on your show. Thank you.
Yeah, looking forward to it. So I understand you're in New Zealand. So I normally I'm talking to a lot of native state investors. So it's good to always talk to international investors and kind of get your thoughts and feelings about different topics. But before we kick things off, I know we had kind of chatted pre-show about kind of your background and your company. Would you mind sharing for our audience how you got started in real estate?
Yes, absolutely. We can go way back when I was born and raised. I was born and raised in Israel. Actually, my mother is American, so I'm an American citizen. So that's what allows me to invest freely in the United States and travel back and forth as I please between New Zealand and the United States. My mother was born in Chicago. But as a child, I was, my dad worked hard and gradually bought apartment here and apartment there. Over there, there's not many houses. There's more like apartments and buildings. And I remember as a kid, I used to go and help him out painting and collecting checks and just doing some maintenance work with him. So that was really my first taste of real estate. But gradually, I evolved and had a profession. I started as a jeweler for that matter in Israel. And at some point, I wanted to go and get be free from working in a store from 9 to 5. So I kind of got my license back in Israel. And that was really my first taste of being self-employed in the real estate business. I was working as a real estate agent for a while until about a year or so, until we moved to New Zealand. Back then with my girlfriend, now my wife, we moved to New Zealand. And in the first, 2-3 years in New Zealand, I was just also trying to find my feet and way to make money. Always had the entrepreneurial spirit in terms of wanting to do my own thing. So I started educating myself. Back then, I was doing a lot of manual labor in the vineyard and orchards of the area. We live in Central Otago, one of the best Pinot Noir wines in the world. So I was listening to back then CDs and some MP3, shows on an iPod or MP3 player, and really getting myself educated through surrounding myself with like-minded people. I started wholesaling properties, so I really started doing assignments of contracts and contemporaneous settlements, which is double closing, basically no money down transaction back in the day, around 2006, 2007. And gradually I started building my own portfolio. So I started closing on deal and fixing and flipping and making larger profits, and started building my own portfolio of small multifamilies, and now as well incorporated with some strip mall commercial real estate. So about 4 or 5 years ago, the New Zealand market really gradually matured. It's really matured. It's like now it's more like, Dallas, even how Dallas matured in the last 10 years. But it's more like San Francisco, Boston, Washington. So the cap rates are really compressed. So everything I bought, 15, 20 years ago is really, really appreciated, and really there's a lot of equity in it. But the return on equity, if you like, the cash flow that it's generating is generating because I owned it for so many years, but it's not really enough to if you want to grow your business in terms of adding more assets. Right now, you can't really grow your cash flow base if you're buying properties at a 5 or a 3 or a 4 cap mainly. So at that point, I decided that I'm going to look further afield, get myself educated, and learn how to invest out of area in the United States. And since then, I got myself educated in the state, travel regularly, and started building a portfolio in America.
And as far as kind of like you, because you mentioned like with that different market where it's kind of like a lot of those hyper markets where you're seeing cap rates are being suppressed. What kind of target markets were you kind of looking at in the States, and what are some of the markets that the characteristics that you think are a good market that people should be investing in?
That's a great question, Dwayne. So we really, first of all, for me, I'm not looking for an appreciation market. So I'm not looking to buy in the markets where it's an appreciation play like San Francisco, even like Dallas today. It's just the yields are not good enough for me. I'm looking for a cash flow market. But in saying that, we do want to see good fundamentals, good metrics. Like for example, we research the market and we look for job growth and population growth. We want to see a steady economy and a good price to rent ratio. We want to see job growth of minimum 2% for around 2 years, let's say consecutive 2 years. We want to see an unemployment rate below 5%. So before COVID, most parts of the United States were around 3.6%. While now we know it's about, in some areas 10%, some areas 9%, some areas even more. Depends on the city you're at. Back in 2010, the average unemployment rate reached about 9.9%. So it's really a matter of finding the right market. COVID is not really an indication right now of what the market is, but we do like to have markets as well that have a good diversity of employments. We don't like to see markets that has, for example, one employer in the area, or like, for example, even just like a timber mill station, or one factory or 2 factories that basically employ most of the people. We like to see diversity of employment. It's very, very important. We like to see median income, if you like, of $50,000 in the market per annum per year for the market or the market. This is very, very important. And we really focus on that, and also on the median house price. So we like to see median house price in the sub-market of about, let's say, anything from 120 to 150,000. The reason is that this is kind of high enough for some people not be able to afford that, and perhaps able to stay renters for a long term, because we are focusing on blue collar workforce housing, C and B asset types, which is typically we're looking for a value add asset we can push some appreciation, we can implement a management plan and really turn the property around, create equity through the process, and get good cash flow at the back end.
And as far as kind of like your target, as far as the project specifically, I mentioned kind of value add through like improving the management. Are you guys open to looking at kind of like deep value adds, where you guys are doing like large projects there? Or are you just kind of looking for something that you can get in, make some, cosmetical changes, management changes to, improve it and streamline it that way?
Yeah, we are open for deep value add. For example, my latest acquisition in late last year was 30% vacancy with a lot of some delinquencies, and we will probably go down up to about even 50% vacancy in that matter. It's a heavy lifting in terms of servicing the debt, within the first year or 18 months, but it's very rewarding. So we like that heavy value add. We will take on, for example, some structural issues, but it really depends what they are, and if you need to involve with the city and how much it's really involved with with red tapes, if you like, to go through the process of doing that. One of the easiest way to add value to multifamily or any income producing asset is to be able to find an asset which, for example, with multifamily, the rents are significantly under market. And that's pretty much a low-hanging fruit. So with that particular asset that we bought in late 2019, there was about 25 to 30% loss to lease, which means that the market around the rented by that much. For example, 2-bedroom unit was rented for $450, while the market rent was $600 to $625. So by getting into the asset and spending about $5,000 a door, we were able to replace the flooring with a vinyl plank flooring in the wet area in the kitchen and for example the bathroom. The bedroom, we typically put some carpets, paint throughout, some fans, light fittings, ceiling fans, light fittings, resurfaced countertop or granite. We did some granite, and did some new outlets, USB outlet to give it the modern feel. And a lot of people got smartphones these days. They just want to plug them in the into USB outlet. We find that it's a very cost-effective investment, but it's a wow factor for people. They love it. We did some backsplashes and appliances. So that's roughly about $5,000, and that allowed us to increase the rent from $450 to $625, for example.
Yeah, I like that a lot. And you're very known because I've been, as we just kind of talking beforehand, that you're physically in another country and you're doing deals here in the States. That's the kind of big thing that people are curious on how they can be able to do that. We had talked briefly about some topics regarding like building a team and kind of structuring it, but you teach in your mastermind regarding 3 pillars, like locating deals and partnering, asset management. Can you go over those 3 pillars for us that include kind of some of the elements we just spoke about?
Absolutely, absolutely. Before we touch about the 3 pillars, I want to reiterate 2 things. The first thing is that you really need to build a good team. So by doing that, you need to first visit the market. You need to network with people within the market, people who are active in the market, and ask for referrals. It's very, very important because you don't want to start blank. You don't want to start looking for a good property manager or a good HVAC company that's not going to charge you an arm and a leg. You need a good handyman. Depends how much you want to be hands-on. The more you're involved as an asset management point of view, the more you're going to be able to cost save, especially if you're out of area. So building your A team, as we said, is very, very important because you are going to leverage the local knowledge and expertise to be able to operate efficiently and also, operate in a way that you keep learning the market and getting yourself educated. And there are more opportunities. Once you network with local people, you get to know the market, you get to know the player, and it's very, very important. You really have to seek referrals for property managers when you start. After you've chosen the market, after you looked at all the demographic, everything in terms of the job growth, population growth, where is it going, then you go in and you start building your team. So you're seeking referrals for property managers, lenders, title companies, building inspections, handymans, anything you can. You can even jump on bigger pockets or attend local meetups. Very, very important. One thing is also to mention is that you want to make it clear that you really need to be prepared to visit the market regularly. Whether you are in the United States, flying from the East Coast to the center of the US, or whether you are out of the United States, you need to be prepared to visit the market regularly. If you're in America, you want to be there at least on a monthly basis, especially in the beginning when you get yourself stabilized and get yourself familiarized with the street, familiarized with the neighborhood, and with the professional within the market. If you're out of the United States, or if you're in Hawaii or traveling, you really want to try and make it at least every 3 months if you can. And it's an investment, and it's tax deductible as well. So that's what we did. I mean, that's what I did. I was traveling regularly and until I got my base cover and I got my boots on the ground. Mm-hmm. Once you stabilize, it makes it much easier. So that's very important. There needs to be a point of commitment that you're going to decide to go and give it all in and be present in that market. Because if you're not going to get the deal flow. You're not going to get the pricing. You're not going to be able to manage the project in an efficient way. Very, very important. And I like to mention that we do have on our MIHmastermind.com website, we have an education tab there. And there is a free course about investing out of area, how to build your rating, how to research the market, and various other things. It's a video course and an ebook that your listeners can get download for free. So please visit if you're interested.
Yeah, appreciate that. We'll make sure to have that information on the show notes so people can click that and check that out. Can you kind of go over, I know that another big thing is underwriting, because obviously, you got to look at the market and get your team in place, do a whole bunch of stuff, but underwriting the deal, and especially how does that change now during like the COVID situation? Are you more aggressively underwriting as far as kind of the stress testing it to make sure that in case something like this happens, like this black swan event, that you're prepared and, you kind of make your plans in order to still be successful even during times like this?
Yeah, absolutely. I will touch on underwriting, but I also want to just quickly mention the 3 pillars of multifamily, because I went on.
I apologize.
So I will briefly touch on that because you asked. The 3 pillars are simple: choosing the right markets that cash flow, creating deal flow, that's the next step, networking and partnering. It's very, very important. So you really need to have people around you, like-minded people that you like and you trust. You really, 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 really need to surround yourself with like-minded people, because if you don't, it's going to be hard. Real estate is a long game. It's a marathon. It's not a sprint, and it's not something that will happen overnight. When I first moved to the United States, after building my team and choosing the right market, it took me a few months, or even 18 months, to land my first big deal, which was very lucrative with a lot of meat on the bone. So persistence and support is very important. Now, in regard to underwriting, if someone is not familiar with the terms, is basically analyzing the deal, analyzing a real estate deal. So nowadays with COVID, things are a little bit different because we are experiencing an unstable time with collections. Although most people are reporting that the collections are not doing too bad, later in early 2021, when the moratorium is going to pass and people will basically could be evicted, things might change and people might start defaulting. There's also a lot of talk about small businesses not being able to come back to the market. So it's really something that we need to watch out for in terms of when we underwrite. Now we basically stress testing the deal, and I'm looking into my notes here. We are stress testing the deal today on how they are going to perform moving forward. So the things we are looking for is basically we are looking at different scenarios. When we are doing stress testing and analyzing, we're looking at different scenarios. We are basically, for example, increasing the economic vacancy. So economic vacancy, if you're not familiar with that, let's say, for example, you have a property that it's 100% occupied and 100% of the people are there, residents, but for example, only 90% of them are paying rent. So you have a 10%, what we call an economic vacancy. It's not a physical vacancy because the property is 100% occupied. So the economic vacancy is basically whoever is actually not paying, whatever is not paying. So what we like to do, we like to allow for the first year now, we stress tested by a 20% reduction in vacancy. So we increase the vacancy, the economic vacancy, meaning less money coming in. We even stress testing to see if in year 2, we will have a higher vacancy. We're even increasing it up to 25%. And other metrics we really, really like, and that's not COVID related. We always like to buy deals that there is enough buffer, if you like, enough upside in the income to create what we call a margin. So a margin is basically the percentage between what would you need to be to break even. So how much rent would you need to collect a year to break even to cover all your costs from the complete rent roll. So we like to have at least 30% margin, meaning that the property can be 70% vacant and still cover the cost. That will be the line between needing to bring money from home or propping up the mortgage, propping up the expenses. So the property at 70% occupancy could sustain itself and keep producing the if you like, covering the cost. So that's what we call a 30% margin. Another thing we use these days when we do stress testing, and we do that on a regular basis, not even in COVID as well, when we play with the numbers, we plug the numbers in the underwriting, the analyzing sheet, and we play with amortization. So we do 15 years amortization, 20 years amortization, 25-year amortization, and a 30-year amortization. And the reason we are doing that is because in some situation, when you buy a value-add asset, the lenders that you're gonna be able to use, the community banks, which is another point to mention quickly, is that when you're moving into a new market, when you're deciding and choosing the right market, get your relationship with community banks established early on. Very, very important, because when you're finding a deal, which is a hairy deal, if you like, a heavy value-add deal, or with vacancy, or with a lot of some issues that needs to be addressed, the community banks will be the one that will fund the deal because they are familiar with the market, they're comfortable. Agency debt, which is Freddie and Fannie, will not touch a property. Obviously, there is a size related, so they don't do small loans like 500,000, 300,000, 600,000. Minimum, there is about, I think Fannie can do up to 750, depending on the loan. But typically, they want to see 90% occupancy for 90 days. So if you're buying a property which is not stabilized, which is value add, which is vacancy, or which wasn't occupied for a long time for 90 days, occupancy, 90% for 90 days, then you won't be able to get agency. So that's why your relationship with community bank is very important. But typically, community bank give you terms which are different. So they'll give you off the shelf, typically 20 years amortization. So that's why we are underwriting with 20 years. Some banks will give you 25 years. Maybe credit unions are a bit more flexible because they're regulated a little bit differently than banks. Mm-hmm. Some banks, if you're buying an asset which is really dilapidated or maybe 1960s vintage, they will only give you 15% amortization because the property needs renovation, and they're not going to let you have a longer amortization to pay off the debt because they believe the life of the property is a bit different, a bit shorter until you stabilize it. So we underwrite in all situations. When we look at our exit strategy, then we calculate the longer amortization, because if we refinance to Freddie and Fannie, we want to see how it will perform at year 3, 4, or 5. So we're playing with those metrics of the amortization. Interest rates, long-term principal and interest. For example, these days we can get loans at 3%. We really pay attention to the debt cover ratio and how it changes over the life of the asset. Personally, I'm a long-term investor. I'm generational wealth building, passive income. I'm not flipping apartment communities to generate profit. I'm more of a refinance and roll the money into the next deal approach. So we're looking how it will look once we are stabilized the asset after a number of years, after the principal and interest kicked in. If we had an interest-only period for 1 or 2 years, then we want to see the P&I, how does it look like in year 3, 4, and 5 moving forward. We're also doing it new, if we have a balloon in 5 years or after 3 years, then we want to see how would the asset perform with higher interest rate. It wasn't so long ago that interest rates were around 6% from some of the community banks. So we also plugging in, for example, at 6% principal and interest to see how would that look. Now we are in a low interest rate environment that could last for another, who knows how many years, could be a few more years. But we always stress test it. We want to see, you never know what's going to happen. Very, very important. We play with interest only typically between 1 to 2 to 3 years, depends on what we can get. We are very conservative with the underwriting. We always like to do a stress testing of various scenarios. When we are looking at what we call the exit cap rate, meaning that you stabilize the asset, you got it to where you want to get it, you increase the net operating income to the level that you predicted that you could perform at, then we are applying an exit cap rate. Now the exit, not necessarily meaning to sell the property, it also could be applied when you want to refinance the property. So basically you are applying this percentage point. For example, you bought the property and you know that you bought it really low. You bought it because it was 30% vacant and 30%, for example, below market rent. The price you paid for the property, comparing that to the income that it was generating when you bought it, because of the vacancies, because of the low rent, was reflecting a very low cap rate. Maybe my purchase was like 4.8% cap rate. if you divide the NOI to the cost of the property. So we're not really looking on entry cap rate. We are looking on where we can take the property to, because we knew that once we stabilize the asset, the net operating income is going to be significantly higher, which will reflect a different baseline for the income. So for example, you know that your market is it's a 6 cap. So what will happen maybe in 5 years' time? Nobody knows. You can estimate that it might be still the same at the 6 cap, if you like, to refinance or sell the asset. But what we like to play with the exit cap rate, if you like, 1 or 2 points above. So we're going to stress test it on how would the property, or what would the property be appraised for if the cap rate is a 7 cap, if it's being increased, or if the cap rate is even 7.5 cap, so 1.5 points above what the market cap rate is right now. Last metric that we look at is how would the property perform when we refi and roll, when we refinance the property, which is our premier strategy that we do. Basically, you got the property appraised, you build up some equity, and the bank, the lender, the new lender, whether it's Freddie and Fannie or whether it's another community bank, they will lend you, for example, 70% of the new appraised value. So if you build enough equity, that new appraised value could potentially basically cash you out from all the costs that you put in the deal, which will be your down payment, everything you put, if you put any money for the renovation, and repay the loan that you had, the first loan. So the loan proceeds will be all returned to you with your money, and you'll have zero money in the deal. So that pretty much brings you to a point that you're 100% financing. You have 100% financing on the deal. There's no money down in the deal. So we stress test the asset to see how it will perform once there is zero money in the deal, once you refinance and roll all your money out of the deal. That's really the last point that we look at.
I like that a lot because, like I said, you go through like a very conservative look where you look at every single thing that could possibly go wrong and all of the scenarios of you on the outside and of course with the ultimate, because you guys said you guys played a long game of pulling all your money out and just keep rolling it in, building passive income, building a nice long-term portfolio. So I definitely like that a lot. And you had mentioned as well, because you're doing, international businesses and, doing all of this stuff. You had mentioned another thing that you talk about, I think, in your mastermind as well, is the elements of successful business. Can you kind of talk about those a little bit briefly as well, and also talk about your mastermind group that you host?
Yeah, absolutely. So yeah, that's very, very dear to my heart, the 5 elements of successful business, because I know how hard is it to work in real estate, especially when you are trying to go and do it on your own. It could be quite a lonely thing to do on your own, because a lot of people have limited belief that they can't do it, and they don't have enough money to do it, and they're stuck in the 9 to 5 day job, W2, and they just can't find the way to do it. So one of the first thing that we teach in the MIH Mastermind is focus. You really have to stay focused. And once you've chosen a niche, for example, if you've chosen to go with multifamily, you need to stick to that. You need to get yourself educated and avoid the shiny object syndrome. You need to become an expert in your field and in your market. So you go in, you learn everything you can about that. You surround yourself with like-minded people, and you go and immerse yourself in the market, in your chosen market, so you can identify an opportunity when it comes along. Because if you're not getting yourself familiarized in your market, you're just not going to identify this opportunity, and you're not going to get the deal flow from brokers relationship, from direct to owner relationship that we teach how to implement. Multiple market is a lot of people go in and they say, I want to invest in Arizona, I want to invest in Texas, I want to invest in Colorado. They're spreading themselves too thin. They're not getting themselves established in one market, building those relationships with the brokers, with direct to seller, and being present in that market. Another thing that people do, which to take them out of focus, they are really giving up really quickly. So they give up. They basically look on different real estate strategies, maybe wholesaling, maybe lease options, many different stuff that they're trying to make money out of real estate, instead of focusing on one thing and making it happen. Very, very important. It even happened to me. I'm saying it from experience. I had a period of time quite a long time ago that really I just couldn't get deal flow when I was wholesaling, and somebody approached me with doing some online marketing stuff, a business directory, and I spent a lot of time and money trying to sell it and trying to build a website and everything else, and it was just a complete waste of time and money, because you need to stick to one thing, make it happen, and stick to what you're good at. Once you pick up momentum, if you stay focused, the ball will start rolling. Very, very important. Point number two of the 5 elements of successful business is measurable action. In the mastermind, we do teach for students to have a quarterly action plans with key performance indicator. You really need to have 1-page plan that has 3 focus areas for the quarter. Very, very important. We ask the student, what is the most important areas in your business to focus on in that quarter? So really, what are the things, small palatable things that you could achieve, not going and trying to conquer the moon in 1 quarter. It's all right to have big long-term goals, but to make progress and feel accomplished and really make steps towards your main time goal, you need to have a small palatable action step within the first quarter, within each quarter. So we really, really encourage to have 3 focus area. We help students to conquer them and stabilize them. Potential focus area, for example, could be even to a wholesaler, even to any real estate, to increase deal flow, improve your broker's conversation system, progressing on key projects that you have, finish them up, setting up meetups, for example, selling a property, making specific key hires. For example, when I started really scaling up my business, I had to hire an assistant. So I had to hire a virtual assistant, and it really changed my life. It really changed how my business operated. Now I'm able to focus on what we call the A and B level activities. All the lower level activities, the C and D levels, they are being delegated now for an assistant to do. And I'm sure you know that as well, Dwayne. You need to free up the time. You need to be focused on the most productive things for your business to grow your business, if you like, build a business, not a job scenario. Mm-hmm. So it's very, very important, because if you work on the admin stuff, if you work on the things that are time consuming and you're not even enjoying them, so it's not really, it's not going to make you happy, and it's not going to make you grow. Very, very important. And there are many virtual assistants in the Philippines and other areas that do not cost a lot to use. It's very, very, very highly recommended. Point number 3, proper time management. Very, very important to be organized. I use this. This is a weekly planner, if you like. In the beginning there, you might not see it. It says the morning routine. So every morning I do meditation. Mm-hmm. So I do, that's my thing. I wake up 6 o'clock in the morning. From 6 to 6:30, I'm doing meditation to fix my head, start nice, be in balance. And every person can do their own morning routine. Maybe it's a prayer, maybe it's scribing, maybe it's affirmation. For me, it's meditation. Very, very important. And then I really write down, I really review, if you like, my tasks for the week or my tasks for the day in that matter. We really encourage students and encourage everybody to try and use their calendar as much as they can. Our weekly planner is something that I review every Saturday or Sunday, and I prepare it for the next week. So I know small things. Hey, contact Eddie, the handyman, make sure he installed the ceiling fans. Follow up with new leases, make some phone calls to the lender, set up meetings for the mastermind. Go and meet Dwayne on Friday morning. Now it's Friday morning with us. We are a day ahead at 7 o'clock in the morning. Make it happen. So all of those little things needs to be written down. Even small things like now we got the votes as well. It's voting time here in New Zealand as well. So go and vote. Go and make it happen. Cross it out. And it's just one of those things that you need to tick off. So very, very important. Good times management. Your weekly planner is your accountability and execution process. Your engineer, if you like, of achieving your big picture's goals. Each action steps and milestone that you achieve shouldn't take you more than 2 hours, for example. If it takes you more than 2 hours, if you got a project to do, if you want to write an article, or if you want to prepare content for an interview, or whatever you want to do, If you want to research a market, maybe cut it down. If it's more than 2 hours, split it up to separate tasks, maybe even on separate days, consecutive days. So you don't want to be overwhelmed. You don't want to be doing half a job. You want to do it in a palatable. You want to knock it down and move on to the next step. Very, very important. Figure out who does what and when. If you need to delegate something, if you need something done, is it something that you should do, or maybe you should just remind your virtual assistant how is it going, or to do something. You just follow up with that, but she needs to execute that. So I use Asana. Asana is a great tool as well for time management and project management, and it's just been awesome. I communicate with my assistant with that a lot. So yeah, like we said, very, very important time management. The next point, number 4, is understanding your financing. Budget what you can afford. If you want to get into real estate, you need to talk to a mortgage broker. You need to talk to your lender. You need to look at your retirement plan, maybe your self-directed IRA, your 401k, or your EQOP. You need to understand if you can use those your savings account. Where are you at financially? What properties you can take down on your own, or maybe you have a 9-to-5 job and you just want to get educated. Meanwhile, you want to invest passively with other operator. So you need to see if you can use your 401k or EQOP, any retirement plan you have, to do that. Get your ducks in a row. Very, very, very important. Again, part of understanding your financing is as well to understand your underwriting. We created the ultimate underwriting tool, if you like. It's a course. It's a course to underwrite multifamily apartments for private investors, partnership, joint ventures. It's not something that, if you like, it's level 1, but very, very good course. But it's not a syndication model. It's not waterfall and all those mind-boggling things that a lot of people don't need in their real estate career, specifically when they started. And people are feeling daunted for that. So we created the ultimate underwriting course. By the way, there's a link on the MIH Mastermind website as well to give to students as they join, so they can get themselves educated. Because if you don't know the numbers, you're not going to be able to make a decision and decide if the deal is good or not. And a lot of people we find are very concerned. They're kind of holding back from learning how to analyze deals because it's a number thing. Not everybody enjoys that. So we have people working together as a group, and we have if you like, an underwriting, deal analyzing groups that work together, brainstorm. It's really, really helpful. And the course is great. It's really small videos with some quizzes and other content, which helps to understand each stage of the underwriting. Again, when we're talking about understanding your finances, it's another point. The last point on that part is understanding your business key performance indicators, KPIs. Very, very important. For example, for me as an asset management, I'm tracking collections. I'm tracking the fees, rent growth, delinquencies, everything to do with managing the project, the financing side of the project. I'm reviewing the statements. Well, my assistant does. I just review the final result now. So it's very, very important to be onto it, to really get your financials in order. Very, very important. The 5th and last point, Duane, is accountability. For me, it's Mastermind. For me, it's my business partner, Marco, who we keep each other accountable on a regular basis with things to do with the business, with growing the business, with deals, with anything we need to. It's very, very important. Accountability is the glue that ties commitments to results. If you don't have accountability, if nobody keeping you accountable, you will not progress. A lot of people, they're not self-driven like myself. I wake up in the morning, I go all in. It's just my nature, That's just who I am. And Marco is the same. We just make it happen. We just go. That's why we became coaches, because we got the energy behind us. We got the ability to stick to it and go in and just persist, stay focused. So we have students in the mastermind who said they're going to do the underwriting course, and they need a bit of a reminder every week. Hey, how did you get on? Did you do the next chapter? So it's very, very important. Accountability is the glue that ties commitment to results. That's the last thing. It's really, really, really important.
I actually like that a lot. Yeah, and it's kind of encompass everything. I know we had a very well-rounded interview, kind of talking about from kind of what your investment criteria is all the way down to the, the pillars of success and elements of successful business. So, and that really kind of answered a lot of the questions that I had after that, which is, kind of revolve around mindset and systems. You mentioned that you use Asana. You have like other timesheets that you use and meditations and things that get your mind right. So that kind of covers that there. But my biggest thing I always ask all my guests towards the end of the interview is about encompassing gratitude. So what can you say that you're most grateful for?
Part of my morning routine, if you like, when I meditate, I close my eyes, of course, and I just think about, thank you for my health, thank you for my freedom, being able to do the real estate for nearly 20 years and being able to have time with my family. That's for me, it's a tool not just to help people to get into real estate now, which I'm greatly enjoying. I'm thankful for that, to being able to help people and inspire others to do that. But for me, it's also a tool to live a lifestyle by design with my family. Before COVID, we used to go, at least 2 holidays, 2 vacations a year, long vacations. Mm-hmm. So I'm always grateful for my freedom, and I'm grateful for my family. Those are the 2 things. And apart from that, we all have our own goals. And one of my goals as well is to be able to help other people. And, we started doing some work that we do in the background, just within the family. And we're grateful for being able to do that. So just gratitude, just being grateful for what you got and trying to be content with your life. Mm-hmm. and appreciate it and understand that life it's a process. Life it's something that we're all evolving, we're all growing, and life throw things to you sometimes that you're not expected, some challenges, if you like, but you need to take them and just understand that you can walk through that and move forward if you are looking at in a positive way.
Absolutely. I appreciate you sharing that as well. So I know we'll make sure to have your link shared. Gave out the web address for your mastermind, and anything else that you're willing to share with us today.
No, I just really wanted to thank you, Dwayne, for having me on the show. It was a pleasure, and I like your show a lot. Like I said, I did listen to quite a few of the podcasts, and there's quite a different mix of things that people can learn with. So I think it's great. And if anybody is interested in some free education, we got some free stuff on the MIHmastermind.com website, different courses. There's a new ebook that I 2 actually new courses. One of them is about the real estate cycle. It's a free ebook. Anybody could go and download it. You can go on the education tab and just download it. There is the investing out of area education there, which is free. There's some other great videos under the free education area. And we have a partnership course and a real estate deal analyzing course, if anybody is interested. So if anybody wants to contact us, feel free to jump on the MIH Mastermind website, MIHmastermind.com, contact us page, send me a message, and I'm really looking forward to catching up with anybody.
Well, looking forward to it. Absolutely. So thank you so much, Hadar, for joining us on the show. Like I said, very insightful, very packed with a lot of information, a lot of good tips. And like I said, to get more information, just go to your website, download the guides, set up a call with you and kind of take that next step. But Hadar, I really appreciate you taking the time with us and look forward to connecting with you again soon.
Thanks a lot. I appreciate it.
All right. Take care, my friend.
Thank you.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwayneLClark.com, as well as find us on Facebook for more useful content and resources.